In this presentation, we will take a look at the benefits of a flexible budget as compared to a fixed or static budget. Last time we took a look at the fixed or static budget and we compared the budget that we had to the actual numbers and then the variance or difference between them. And we determined that we had a favorable difference for the sales, we had a favorable difference for the net income, and an unfavorable difference for many of the expenses. And that is what we would expect if we had a situation where the budget was based on a lower number of units, 10,000 in this case, versus the actual number that was actually produced, 12,000. And that means that although we have a favorable difference in terms of sales and net income and an unfavorable difference in terms of the expenses, that is what we would expect given the fact that we had the higher production level, which is in essence a good thing. But these unfavorable differences don't really give us enough for us to go in and improve with. It's not enough information for us to go in and make decisions on how we can better our expenses or control our expenses better or budget better. And so in order for us to do that, we can take this information, break it out into a budgeted or a flexible type of budget, and then we can make this comparison based on 12,000 units, meaning we can adjust our budget as if it wasn't based on the 10,000 but 12,000, and therefore compare the budget to actual, both being based on the same number of units being produced, 12,000, and then look at our variances, which would be comparing the same thing, apples to apples as they say, and give us some more information that we can then further possibly break down and make decisions on. To do that, we're going to take our standard type of income statement and break it out into a contribution margin type of income statement. So you see we have here the standard sales, cost of goods sold. It's broken out by category of what the expenses do for us, as opposed to the behavior of the expenses, the fixed and variable. So we're going to come up to a budgeted income statement that will be a contribution margin, same bottom line, 7,900. However, it'll be in a format of behavior. We have the variable costs, then the fixed costs. So a flexible budget might look something like this. We want to be able to break out the sales by unit, and then we want to be able to break out the variable costs by unit. So we're going to say they're variable, and therefore they're going to have a constant change with the number of units. That's going to be the point. That's what's going to make it flexible. That's what makes it flex, the budget be able to flex. And that'll give us the total variable costs, which is going to be the 4.8 if we add up all the variable costs here, variable costs per unit should say, and then the contribution margin per unit is 5.2. So, and that's going to be the 10 minus the 4.8 contribution margin per unit. The fixed costs then will be fixed. These will not change as the level of production goes up. And therefore, if we then take a look at different production levels, starting off with the one that we budgeted based on, the 10,000, we can take our sales of 10,000, multiply our sales of $10 per unit times 10,000 units. So $10 times 10,000, that gives us the 100,000. Of course, the 1 times the 10,000 gives us 10,000. The 1.5 times 10,000 gives us the 15,000. The 2 times the 10,000 gives us the 2,000 or 0.2. The 0.3 times the 10,000 gives us the 3,000, and so on. So you see that it's going to change in relation to the number of units. That's the point of us breaking it out in terms of a contribution margin type of income statement. So that gives us a contribution margin of the 52, which is the 100,000, minus the 48. And that gives us our 52 contribution margin. And then the fixed costs do not change. They're fixed. So kind of like the rent, the depreciation, the supplies, the insurance, they are what they are. And then if we add those up, the total fixed costs, 44,100, and the contribution margin, the 52 minus the fixed cost of 44100, gives us that 7,900 of the income from operations we saw in the prior income statement that was formatted in the traditional fashion. Now with a flexible budget, we can then do this for different income levels. So what if we had, what if not income levels, but production levels? So what if we had 12,000 units then? Well, if we had 12,000 units that were produced, now that we have broken this out into a contribution margin income statement, we could simply take the 12,000 times the sales per unit, 10, 120. We could take the 12,000 times, obviously 1, the direct labor is 12,000 times 1.5, 1.5, and that'll give us the 18, and so on and so forth, breaking out all these numbers to get to the total variable cost contribution margin. The 120 minus the 57.6 gives us the 62.4 contribution margin. Fixed costs, once again, are the same. They're fixed. And then if you subtract that out, we would have the income from operations 18.3. And of course, again, we could do this for any type of level of units. That's why it's flexible. So this flexibility then really helpful for us, one, to plan the budget. It's really helpful for us to use this contribution income statement to plan the budget, go through what if type of analysis, because you'll note that that if we did this to a master budget type format or the traditional income statement, and we changed the level of production, it would be a lot more difficult for us to go through the income statement and kind of figure out what the change in net income will be. If we break them out by behavior, it will be much more easy to do so. The other thing that's really nice about this is that once we have gone through the actual time period, we can make a comparison of apples to apples, or the same thing to the same thing. So in other words, if we basically thought or had our main flexible budget, our main budget at 10,000, and we actually produced 12,000, then we could say, okay, let's take our 12,000 budgeted, flexible budgeted numbers, compare them to the actual results. And then we're comparing something that's budgeted based on the same number of units as actually were produced. And that variance then will be something that we can use, easier to use. So in other words, here's our budgeted numbers at the 12,000. If we compare that to the actual numbers now, so now we took our actual numbers and we broke them out into a contribution margin type of income statement. Now we could do our comparison, and it's going to give us better information. It'll give us something that we can actually compare and drill down on, dig deeper into. So in this case, we had the actual sales now, 125 versus the 120, still favorable. So sales still have a favorable difference. If we take a look at the direct materials, we're at 13,000 actual and 12,000 on the budget, and therefore we have an unfavorable difference. And now we could take this unfavorable difference and go to the people responsible for the direct materials, for managing the direct materials, and say, hey, there's an unfavorable difference. And it's not due to the fact that we produced more than was budgeted, because now we're using a flexible budget. Now you'll see that we may have to break this down even further. That might not be enough, because there might be multiple things involved in this difference in the calculation of direct materials. But this is the first step. This is something now gives us a number that we can start to take that and then maybe piece it down further. The direct labor, also unfavorable. Same thing. Now we could go to the people involved with the direct labor and say, hey, look, there's this issue. And again, we might have to break it down further to see what the actual difference is. Is it a difference in the rate, or is it a difference in the quantity, the number of hours? So we'll still maybe have to take this number and break it down, but this gives us more information than a static budget would. And then the factory overhead, we've got a favorable difference. We've got the utilities is going to be unfavorable, and so on and so forth. So if we go through this all the way through, favorable, favorable, unfavorable on the total. Contribution margin is favorable. The fixed costs should be somewhat similar because they're fixed typically, but we'll see the favorable and unfavorable differences for the fixed cost as well. And this will give us, like I say, a better same thing to same thing based on the same level of production, budgeted numbers versus actual based on the same number of units. And now we could go through these individual units and start to go into our processes and see who's responsible for these items, and then start to see if we could better budget, see if we could start to become more efficient with our expenses.